All right, welcome everyone to episode number 19 of the Easy Talk podcast. Only 19 and it feels like a lifetime, right?
Yeah.
I feel like it's been a long time doing the podcast. So today we're going to be talking about car loan in general. So what we want to do is we're going to try to explain all of the terms, what's a payoff, what is the principal, all of those things. We're going to try to explain them the best we can for people that maybe are not that knowledgeable about it. They can, know a little more.
Right.
Yeah.
So basically, the way you start setting up the structure for a car loan, you start with the price of the car, right? Then you add the legal fees such as the taxes. Depending on the state, is different. Here in Florida, it's about 7%. Tax, tag, and title. Usually dealer fee, and then any other fees or any other back-end products that you're buying, such as an extended warranty or gap insurance. If you add those together, it's going to give you an out-the-door price, which is the total price that you're buying the car for.
Right.
Then, if you're doing the down payment, any kind of down payment, let's say the out-the-door price is $20,000 for the car that you're buying. That's including everything, like I said, taxes, gap insurance,
Right.
Tax
Out the door.
Out the door.
When they say out the door means
everything.
that out the
Right.
door, like you're driving the car.
Right. So $20,000 out the door. Then you want to do $1,000 down payment. So the down payment you subtracted from the out the door price, and in this case, it's gonna give you a $19,000 principal or amount to be financed.
Exactly.
Okay, which is 19 grand that you'll be financing. The lender is gonna lend you that money and finance the car for you. So that's gonna be the $19,000. It's gonna be usually the payoff or principal
Exactly.
that you're gonna owe on the car.
Right. And that's why lending companies or the dealerships, it's usually better when the customer does more down payment, because the more down payment you put towards the vehicle,
Less money.
the less
owe.
money you're gonna finance. So that's why it's always better, usually always better to
Right.
put
Yeah, it's less money that you owe on the car.
exactly.
So then the interest rate, let's say that you do a 3% interest rate, the finance charge, which is how much the lending company is going to charge you for lending you the money, that's the interest that you're going to pay. It's based on the amount financed on the principal. Okay, so the 3% interest rate is going to be based on the $19,000.
Exactly.
Most of the auto loans are simple interest, structure, so it's pretty basic. Then you have the term, how long you're going to take to pay off the loan. It could be anywhere from 12 months up to 7 years. It depends on what the lender can approve you for, and also how quick you want to pay it off. The fact that the payments are higher, in a shorter term, does not mean that you're going to pay more for the car. It's just that it's actually better because you're going to pay it off sooner.
Faster.
And you're going to pay it off faster, because the longer you take to pay the car off, it's more interest that you're paying, because you're using or you're borrowing that money for longer term.
Exactly.
That's pretty much how it works.
Exactly.
Then you go into the payments. There's a financial calculation. Usually, every payment you make, you pay a little bit of interest, and then most of the time, the biggest portion of the payment goes towards the principal of the car.
Right. It balances out. So
Yeah.
when you start, or at least the way we do it here, and I've seen other loans from other car places as well, and that's usually how the simple interest works. Usually you start paying off more interest and less principal. and it just switches out.
Right.
So by the end, you're paying more principal and not much
Right.
interest. So it's just like an X,
Right. And then there's another number, which is the balance, which the balance is different from the principal or the payoff.
Right.
The principal or the payoff is what you owe on the car, not including the interest. The interest, you actually don't owe it. It's something
Till
that
you
you're gonna
use
pay. Something that you're gonna pay over time. Like I
Exactly.
said, the longer you take to pay off the loan, that's when you're gonna be paying the interest rates, the interest, and then the balance is the calculation of how much you will end up paying at the end of the loan if you take the full term to
Exactly.
pay it off. That's adding the principal plus the interest. That's the
Exactly.
whole balance.
Exactly. So when you're looking at your paperwork, maybe when you bought your car, you probably got a payment schedule,
Right.
where it should say all of your payments, with the interest, with the principal, and the total amount, and it should also give you your balance, the balance on your vehicle. The balance, it's always like Jackson said, it's gonna take everything into account. The balance is the final amount of money that you're gonna pay by the end of the loan.
Right.
If you just pay it like it is on the payment schedule.
Right.
So if you take the 3 years or whatever it was from the beginning,
Right.
that's the balance. However, the payoff amount, it's different every month. Every time you make a payment,
It's lower.
the payoff amount, it's lower. So if I'm 2 years into the loan and I have 2 more years to go, but I got some extra money, I call my dealership, hey, what's the payoff amount that it's lower than the balance? And that's what you would pay to
Right.
pay off the car. So you're not paying interest on those
Right.
final terms. That's why it's lower than the balance.
Right.
Usually, I've seen dealerships, if you want to pay off the car, they will charge you like an early payoff fee or something like that. So I guess that depends on every
That
dealership.
depends. Yeah. Every lender, not dealership.
Exactly, lender.
So yeah, that's pretty basic information. I mean, there are a lot of things to know when you're financing a car, but at least know the basics.
Right. Yeah.
If you want to do a quick calculation on how much you're gonna pay for interest, there's a lot of loan calculators out there on
Online.
Google. But if you want to do, it's very simple math. If you have a $20,000 out the door price, $1,000 down payment, you're financing $19,000 a month. So let's say that the payments are $300 for, let's see, $300 for, let's do a quick math here. So $300 for 75 months, for example. 75 months, it's 6 years. Let's do 72 months, so we do the exact 6 years. 72 months is 6 years. So if you're financing $19,000, that's the principal.
Mm-hmm.
The payments are $300 for 72 months. All the payments, just the payments, are going to add up to $21,600. Okay? That's the payments that you're going to make over the 72 months. The principal is only $19,000. So if you subtract that to $19,000, so wait, at $300, 72 months, that's $21,600 plus the $1,000 down payment that you gave. Mm-hmm. So plus $1,000, that's how much you're gonna end up paying for the car. That's $22,600. If you subtract that by $19,000, it's gonna give you the difference, and that exactly means how much you paid on interest, which is $3,600 over 5 years. That's nothing, that's very low. The most likely this structure that I gave it's very low interest rate. So
Right.
again, this is very important. It's something that you can do when you're sitting on the dealership. At the dealership, you get the amount that you're financing, and then you multiply the payments by the term. It's usually month. So 72 months in this case, that give you total payments of $21,600. That's just the amount of payments that you're going to make. The down payment that you're given, so you add the $1,000 to the $21,600. So that's going to give you a total payments of $22,600 minus the principal, which is how much you're financing, minus $19,000 is $3,600. That's how much you're gonna pay in interest. If you want to know,
Right.
If you don't have a computer or something, you can do that math really quick, and it's pretty easy to do.
Yeah. Just remember that you also can you type loan calculator or anything like that on Google, and it'll just make it simpler.
Just type in the information you have.
Yeah, because it will gives you loan amount, loan terms, interest rate, and just hit one button and it will give you everything. So, it's just
right. Now
simpler.
let's do this example so let's say that you're still financing the same $19,000, right? But you want to pay it off sooner. $19,000. If you pay it off sooner, let's say that you make that's $300, 72 months. That's $21,600. Let's say that you want to pay it off in 52 months. The payments will be about $416. So if you do $416 in 52 months, that's going to save you a lot of money on interest rate because you're paying the loan a lot quicker.
Right.
You're not
higher payments, but you
pay less interest rate.
Getting rid of it faster.
Right. So, if the approval they gave you is at $200, but that in your budget you can make the payments comfortably at $350. Just go ahead and set it like that, because that's gonna help you save the money on interest.
Right.
So that's just something smarter to do.
Right. So another thing that it's important to know, at least when you're getting a car loan, is that there are companies out there that are mainly focused on refinancing. And refinancing, I think it's a smart idea always, because maybe the time that you got the vehicle, you were not in the best position. Your credit was not the best. For some reason,
the economy wasn't the best.
Exactly. Maybe interest rates were high at that precise moment. So maybe interest rates went down 2 years later or 1 year later. It doesn't really matter. And you're able to refinance your car for
a way lower interest
rate. Maybe you can lower your payments or everything. So it's always smart to knowing that you have that option to refinance at any moment and lower those payments.
Right. So that's what we have for today. I think it's pretty solid information.
Yeah. It's
very
basic.
Simple.
It's basic. Just remember, we're not finance guys.
Financial advisors,
but we're trying to share what we have learned.
Stuff so something. Because I've seen people walking here looking to finance a car, but they don't know. They know nothing about financing a car, and I always start explaining the best. But you can tell that they don't know what I'm talking about, or they don't really understand 100%. But this is the main goal here. We want to share all this information, important information that's going to help you and give you knowledge and put you in a better position when you're buying a car. Whether you buy here or anywhere else, doesn't matter. But that's just going to help you to make a better decision.
Exactly.
All right.
So thank you, everyone. And make sure to, if you have any questions, Instagram, Facebook, YouTube. If you're listening to us on the podcast, I don't know if you're able to ask questions on iTunes or anything like that. I don't think so. But, you have all the other social
Facebook and Instagram.
media. So take care, guys, and see you on the next one.
Bye.
Bye.